Okay, so we have a question here which says, calculate the net profit for Mr. X for the year ended 31st December 2025. Being given information here, excuse me, gross profit, power costs, marketing costs, bad debts, rent received, provision for bad debt, interest receivable. All right. And we've been given this additional information. So we need to calculate the net profit, which is the profit after you deduct the operational costs. Yes, so usually before you start your statement of profit or loss, first things first is you need to deal with the additional information. Okay, you have to adjust these before you start solving. Okay, so we're going to start with the first adjustment, which is with prepaid expenses. Okay. So, colleagues, prepaid expenses, these are expenses you pay for in advance. Okay? So, in the question, they've told us that power costs include a prepayment, include a payment of 3,000 that was paid on 1st November 2025. All right. The payment will run until January 31st, 2026. Okay. So, according to the matching concept, okay, matching concept says record expenses and revenues for the same period. Okay. Meaning expenses for 2025 cannot be taken to 2026. Revenue for 2025 cannot be taken into 2026. You need revenue for 2025 and expenses for 2026. So here, these power costs, we paid 3,000 on the 1st of November, near the year end. Okay, and this payment runs until January 31st. So according to the matching concept, we need to find out how much of the expense we incurred for 2025. The expense that goes into 2026 is going to be regarded as a current asset. Because remember, prepaid expenses which you pay for in advance, they're regarded as current assets. Okay, because if something should happen, you might ask for your money back and you can be given. Okay, so first things first, we need to know. All right, this payment is running from 1st November to 31st January. Colleagues, how many months is that? How many months is that? From 1st November to 31st January? How many months? 3 months, yes. That is 3 months. Yes. So we need to find out, okay, this payment runs for 3 months. What is the monthly charge? Monthly charge, the payment is 3,000. It runs for 3 months. So the monthly charge is 1,000 per month. Okay. Now, since we know the monthly charge, here what we're trying to determine is how much is the prepayment, how much is the expense for the year. All right. So we need to know, okay, from 1st November to 31st December, 1st November 2025 to 1st December 2025, all right, that is 2 months. Just hold on, colleagues. Just hold on. Yes, so that is 2 months. Okay, so the expense we need to incur for the year, so expense for 2025, 2 months multiplied by 1000 kwacha per month gives us 2000. Okay, so this 2000 is the expense, is the power expense for this year. Okay, then the prepayment, the prepaid expense. Okay, prepaid expense, you're going to say 3000, the whole amount minus the amount for this year is 1000 kwacha. Okay, so this is the prepayment here. Okay, so once you found the prepayment, remember this. Prepayments subtract from the expense. Remember this rule. Prepayments subtract from the expense, from the individual expense. Okay, and include it as a current asset in the balance sheet. Okay, colleagues, remember this for prepayments. Okay, subtract the prepayment from the individual expense. Okay, and add it as a current asset in the balance sheet. So what I mean is this. So marketing costs, is it power costs here? This 15,000. We need to remove the 1,000 prepayment. Okay, so our new power costs, say power costs, new power cost, 15,000 minus 1,000. Because remember, we only want expenses for this year, according to the matching concept. Okay, so 15,000 minus the prepayment of 1,000, you get 14,000. So this is the power cost expense that we're going to see in the statement of profit or loss. Okay, colleagues, any questions? Okay, again, marketing costs include a prepayment of 100 kwacha, and the marketing costs of 300 kwacha were not paid for. So here we have another prepayment and we have an accrued expense. Okay, colleagues, accrued expenses, these expenses you haven't paid for. So another concept you need to remember in accounts, accrued expense, let's see, and revenue for the same financial periods, is the accruals concept. Okay, the accruals concept. Okay, record expenses and revenue or revenue even though money hasn't exchanged hands. Even though money hasn't exchanged hands. Meaning, for example, if this month you incur an electricity bill, you don't pay it, that it means you're owing. You're owing the company. The next month comes, you don't pay it, what you're owing starts building up. The other month comes, you don't pay it, you're owing. So even though you haven't paid for that expense, you need to record it in your statement of profit or loss and in your records. Okay, even though you haven't paid for it. Okay, even when it comes to revenue, if you have done a service for somebody, let's say you had a 3-month contract, they say they'll pay you per month. First month comes, they don't pay you, you record it. That's accrued income now. Second month comes, you haven't been paid, you record it. Third month comes, you record. Okay, that is the accruals concept of accounts. Okay, yes. So this is then what I need you to remember for accrued expenses, because in here we're dealing with an accrued expense. Okay, so for accrued expenses, add to the individual expense and include it as a current liability. Okay, because remember, this accrued expense you are owing, so you need to record it because it's for that year. Okay, yes. Then in the balance sheet, you will find it, the accrued expense appears as a current liability. So for marketing costs, since we've got a prepayment and an accrual, so what is the value of the marketing cost? 7,000. So we subtract the prepayment. Remember this 100 kwacha prepayment, subtract, then include it as a current asset. Then the accrual, add it and include as a current liability. Okay. So we're going to say marketing costs equal 7,000 minus prepayment plus accrual. Okay. So colleagues, for accruals, they won't tell you that this is an accrued expense. You just look for words that say that it hasn't been paid for or it hasn't been recorded. Okay. Then you know it's an accrued expense. They won't directly tell you that this is an accrued expense. They'll just put words it hasn't been paid for, all right, or hasn't been recorded. Okay, so 7,000 minus 100, 6,900. 6,900 plus 300, 7,200. So this is the marketing cost for that will appear in the statement of profit or loss. Okay. Yes. Any questions? So remember that for prepayments and accruals. Prepayments subtract, as you can see, and include as a current asset. Accrual, add to the expense and include as a current liability. Okay. Next, we've been told depreciation for premises is 5% on cost. And we're using the straight line method. Yes. So, colleagues, depreciation is the loss in the value of an asset. If you buy a car today, after 5 years, it won't be the same value. Okay. So, the depreciation, there are two methods. The first one is the straight line method. This is where the depreciation expense is the same every year. Okay. So, they've told us the value of the premises is 100,000. So, we need to calculate the depreciation. Okay. So, this is what we do. So straight line method is just the rate times the cost. Okay. Say depreciation rate times the cost. All right. The rate is 5%. The cost of the premises is 100,000. So we're going to say 5% of 100,000 is 5,000. Okay. So this is the depreciation expense we're going to charge to in the statement of profit or loss, okay, for premises. Now, another note you need to remember, because most of these adjustments here, they're not only affecting the statement of profit or loss, Okay, they're also affecting the balance sheet. Okay, so depreciation, how we record it every time, every year. Okay, according to the double entry rules, remember, whenever you incur an expense, debit, so you debit depreciation expense, 5,000. Then every transaction affects, on average, two accounts. So the account that will be credited is accumulated depreciation or provision for depreciation. Okay, this is a contra asset account, meaning it lowers the value of an asset. Now you won't need to do this journal entry in the questions. This should be, you should be aware of this. So you should know that this same depreciation, this 5,000, if we are making a balance sheet, this 5,000, you need to add it to the pre-existing accumulated depreciation, because as the accumulated depreciation grows, the value of the asset goes down. Any questions before we go to the reducing balance method? Okay, so using the reducing balance method, the depreciation charge drops. Okay, as the years pass, the depreciation charge drops. Straight line method, the depreciation is the same every year. Reducing balance, the depreciation charge drops. All right, so yes. So this is the formula. Depreciation equals cost minus accumulated depreciation. Colleagues, this tabulation here gives us what is called the net book value. Okay, NBV, net book value. Net book value is the value of the asset, the current value of the asset. Okay, the current value of the asset. So probably we can put this as this: net book value multiplied by rate. All right. Net book value, value of the asset, the current value of an asset. So we've been told the cost of the motor vehicles, 80,000. Accumulated depreciation, 7,600. So you see cost, 80,000 minus accumulated depreciation, 7,600 multiplied by the rate, 3%. Colleagues, if I'm moving too fast, let me also know, okay? I have to make sure we all grasp this, okay? Everyone needs to grasp this. Yes, so 80,000 minus 7,600, 72,400 multiplied by 3%. 72,400 multiplied by 3%, that's 2,172. That is the depreciation expense that we're going to charge for the year for motor vehicles. Okay. So remember the double entry, you debit depreciation 2,172, you credit accumulated depreciation 2,172. And as I said earlier on, this credit entry, so you're going to add this 2,702 with this old accumulated depreciation to get the new accumulated depreciation for the year. Okay. Even with the straight line method, for every non-current asset, they'll tell you the pre-existing accumulated depreciation. So when you calculate the new depreciation for that year, add it to the pre-existing, okay? Like in this case. So the new accumulated depreciation for motor vehicles is going to be the old accumulated 7,600 plus the new one 2,172 Okay, and you get 9,772. Okay, but this will be in the balance sheet. This tabulation will be in the balance sheet. Okay, new accumulate. For the straight line method, it's just that I wasn't given any pre-existing depreciation. Okay, but if they said the accumulated depreciation for premises, let's say if they said accumulated depreciation for premises is 10,000, then for that year you're going to add this new 5,000 to this 10,000. New accumulated depreciation. Okay. So please remember this because you'll be dealing with both the balance sheet and statement of profit or loss. So when you time you calculate depreciation, add it to the existing. Okay. Yes. Are there any questions on depreciation? Any questions or queries? Mr. Lloyd, any questions? Madam Esnat, any questions? Madam Ethel, Madam Ethel, Mr. Godfrey, Madam Justina, Madam Malebang, Madam Tandiwe, and Madam Tracy. If there are any questions, feel free to ask. Yes. So that's how you deal with depreciation. Okay. Yes. Then the next adjustment you need to be aware of is asset disposal. Okay. Now here I've just given you a short version of asset disposal here. But in your assignment, there was that one for the motor vehicles that was sold. Okay. So here they told us a computer was sold for 9,000, which had a net book value over 8,000. Okay. So colleagues, in accounts, when you get rid of an asset, okay, you want to find if you either gained or you made a loss on the disposal of that asset. Okay. So the gain or loss on a disposal, gain or loss on disposal is the cash you receive minus the net book value. Okay. So you're comparing how much you received for the asset versus how much the asset was worth. So like in this case, colleagues, this computer was worth 8,000 kwacha, but we sold it for 9,000 kwacha. So it means we've gained, okay? They made a gain of 9,000. This was the cash that was received, okay? So you're going to say 9,000, how much we received for the computer minus how much the computer was worth, 9,000. So if this is a positive value, then you know it's a gain. If it's a negative value, then you know it's a loss. So 1,000 gain. Okay. Gain on disposal. Okay. So this will be added to gross profit. This gain on disposal to be added to gross. If it's a loss on the disposal, you add it with the expenses. Okay. But there's a lot that goes in on asset disposal. Okay. Here I've just given you a small glimpse, but there's a lot. Okay. Then here, provision for bad debts was 5% of trade receivables. Value of trade receivables 10,000. So provision for bad debts, or you might see it as provision for doubtful debts, or even allowance for bad debts. Okay. When you just say or irrecoverable debts, this one can come as many words. Provision, allowance for bad or irrecoverable debts. Yes, colleagues, according to the prudence concept in accounts, okay, prudence concept, where we say basically where we say be honest and don't overstate profits or understate expenses, and also if you expect any future losses, account for them. Okay, the prudence concept is just you being as you being an accountant, be disciplined and honest. Okay, so if you foresee any losses that the company might incur, record them. Do not overstate profits and or understate profits. Be honest and faithful in your representation. So this provision for doubtful debts, knowing that if you sell goods on credit, you're not going to get all the money back. So according to the prudence concept, you must be aware that you might lose out some money on these credit sales. So you cannot know how much you might not get back. All right. But all you can do is estimate. Okay. That's what this provision for doubtful debts or allowance for recoverable debts is. We're just estimating the money we might not receive from our trade receivables. Okay. So this is a contra asset account because this same provision needs to be deducted from the trade receivables. Okay. Yes. So now another important point. If you already see there is an existing provision, have you seen a provision for doubtful debt, 300? Then this is what you need to do. Okay. Since there's already an existing amount here. Okay. So the first thing you do, okay, calculate the provision. So provision equals rate multiplied by the trade receivables. Okay, so the rate is 5% and the trade receivables are 10,000 kwacha. 5% of 10,000 kwacha, that is 500 kwacha. Now, colleagues, this provision that we've calculated here is for at the end of the year. Okay, this one, which was already here in our information, this is for at the beginning of the year. Okay, yes. So you need, because remember, the money that is owed to you by people, it changes. Okay, what will be owed in January is going to be different what will be owed in December. Okay, that's why we're comparing at the beginning and at the end. We want to see, has this estimate dropped or has it increased? Okay, so we compare. Our new provision is 500. New provision at the end of year is 500. Okay. Old provision was 300. So we can see it has increased. Okay. Okay. So new provision minus old provision. If you get a positive value, increase, negative value, decrease. So 500 minus 300, we have an increase of 200. Increase in provision. Okay. So what this is telling us, colleagues, is the money that which we estimate we might not get has increased. Okay. It has increased from 300 to 500. So this increase in the provision for doubtful debts, this one will be treated as an expense. Okay. Increase in provision, expense. Because yeah, it means you might not get more money from the people who are owing you. So you treat that as another loss, which will be treated as an expense. But a decrease in the provision, you add it to gross profit because you're saying that we might get some money back from our customers. So since you might get some money back, that is treated as a gain. Okay, so decrease in provision, gain, and to gross profit. Okay, colleagues? Yes. So in the statement of profit or loss, this 200 is going to appear. Increase in provision under expenses. Then this 500, you need to deduct it from the trade receivables in the balance sheet. Okay? So in the balance sheet, you say trade receivables minus provision for doubtful debts. Provision for doubtful debts minus also bad debts. Okay? Bad debts, this is money you're certain you're not receiving. Probably the person passed away, their business closed, or they just ran away with the money and you never see them again. Okay, so bad debts we have already been told here, were given in our question here. Bad debts 900. This is money we know. Okay, the provision, this is money which we're estimating. Okay, yes. So the trade receivables is 10,000. So this is for the balance sheet. Okay, so you say 10,000 minus the provision 500 minus bad debts. Okay, so I'm going to say 10,000 minus 500 minus 900, 8,600. So in our balance sheet under trade receivables, you have to put 8,600. Okay, yes. Any questions before I now make the statement of profit or loss? Okay, so you always start with your gross profit from the trading account. Gross profit 190,000. Okay, then you're going to say add, okay, gains or income. Okay, so we had a gain on the disposal here. So gain on disposal, let's see, 1,000. Okay, yes. What else do we have? If we had a decrease in the provision for doubtful debts, you would have added it there. Yes. Here, have you seen, colleagues, this rent received? If you just see this word received, just know it's a form of income. Okay. Even discount received, if we never adjusted it in the trading account, you can also add the discount received to your gross profit because since you've paid less, you have saved some money. So that money you have saved is treated as income. Okay, so rent received, we have to add it. This is income. Even this one here, interest receivable. Okay, the difference between these two is this. Rent received, you got the money. Okay. Interest receivable, you haven't got the money. This is accrued income. Okay, accrued income. So this interest receivable, it means you did the job for somebody, or maybe You borrow the money and there's some interest that they need to pay, which is coming to you. All right. So remember, according to the accruals concept, you record even though you haven't received it. But since you haven't received the money yet, so this also be treated as a current asset. Okay, it will be treated as a current asset. Okay, so for accrued income, so we'll put rent received and interest receivable. Rent received 1,000. Interest receivable 500. Okay, and we say you don't need to put this in the but and this goes in balance sheet as a current asset. Okay, don't need to put that, but I just need to remind you, okay, that if you see something receivable, rent receivable, commission receivable, dividends receivable, then you know. Okay, yes. So we total up the incomes: 1,000 plus 1,000 plus 500, 2,500, plus our gross profit 190,000 plus 2,500, 192,500. This is our adjusted profit. Any questions before we now deduct the expenses? Less and less expenses. Okay, so we start putting in our expenses. Okay. Yes. No. Power cost 14,000. We made that adjustment, so it's a power cost 14,000. Marketing cost 7,200. Depreciation premises 5,000. Depreciation motor vehicles, believe it, let's see, it was 2,172. 2,172. Increase in provision for doubtful debts, we put the increase. Don't put that 500. That 500 which you calculated is going in there. It was the one which you deduct from the trade receivables. Just put in the increase. It increased by 200 kwacha. All right. And then let's see. I think those are all the expenses. Oh, wait. Oh, yeah. Yes. So we total up our expenses. Okay. We total up the expenses. So we're going to say 14,000 plus 7,200 plus 5,000 plus 2,172 plus 200. And they're going to get 28,572. Those are our total expenses. Okay, then you're going to say net profit. The adjusted gross profit, okay, 192,500 minus the total expenses, 28,572. You get 163,000. 163,928. 928. This is the net profit. Okay, the profit after you've deducted operational expenses.